Today we will be talking about a small cap manufacturing company. This company will be beneficiary of government and private capex scheme. We'll look into the business model, industry, product and future scope of this company. And the company which we are going to analyze today is Pitti Engineering. So let's start with the history of the company. It was incorporated in 1983 and initially it was named as Pitti Laminations. They basically started manufacturing laminations and they started with an installed capacity of 2500 tons. Laminations are used in electric motors and various other applications. I'll tell you more about this as the video progresses. From 1994 to 2000, PT installed second plant in Hyderabad and they started exporting to USA. In 2017, they started greenfield expansion and what did they do? They installed third and fourth plant manufacturing unit at Hyderabad and mega plant at Aurangabad. So in 2020, they enhanced their portfolio with the introduction of new components for Indian Railways. Additional capex outlay of rupees 270 crore to almost double the capacity by H1 FY24. So they are planning to double their capacity till H1 FY24. And for that, the capex amount is rupees 270 crore. Later, we will discuss about the impact of this capex on the revenue, margins, and profits. Now, as you can see here, these are laminations. They are fitted inside the motor, generators, and other electrical components, and these are used to reduce eddy current in the components. So eddy current is generally produced when a conductor moves through a magnetic field, and eddy current is responsible for the reduction in efficiency of the motor. So one question may arise here: why they are using different sheets here instead of using one big block? So the reason is that if we use just one big block, then more eddy current will be induced. And if the number of sheets are all brought together to make one big block, then because of the presence of air between the sheets, eddy current will be reduced and the efficiency of the motor will increase. Let us not dive deep into the technicalities. So these laminations are manufactured by Pitti. Apart from the basic products, they also manufacture value-added products. Before talking about these products, you must know that motor is made up of two parts, stator and rotor. Rotor is the part which rotates and stator is the part which remains stationary. Pitti manufactures the main material for rotor, shaft assembly, stator core assembly, large die-cast rotor and other parts of motor alternator. And all these are high margin products as compared to laminations. Looking at the product portfolio, Pitti has made some major changes in their product portfolio over the years. Around 1990, they did not have many products. They just used to provide laminations to motor industry. Later in 2000, they entered into aviation, elevators, and generator industry. Manufacturing of stator and rotor also started by Pitti in 2000. By 2010, they started supplying to hydropower projects, oil and gas industry, telecom industry, and today they have expanded their supplies to railways, electric vehicle applications and many more. When we observe, they were just manufacturing laminations in 1990, but by now they have diversified their product portfolio in very organized manner. Their percentage share by volume in quarter 3 of FY 2022 have come down to 32%. In today's date, their major portfolio share is of value-added products, which is 68% or 5,823 tons. Another advantage that Pitti has is their diversified customer base. They supply to various industries and the key customer is railways because 32% of their revenues come from railways including metro. Special purpose motors has a good proportion of around 12%. They also supply to power plant, hydro plants, which constitutes to around 14.5%. Industrial and commercial motor is around 15.3%. All these industries can be categorized into two groups, cyclical industry and structural industry. Now, as an investor, we must know how much portion is cyclical industry and how much is structural. Here, one must know that cyclical industry is something which depends a lot on the economy. As the economy will improve, cyclical industry will also perform better. For example, let us take banking sector, which generally performs well when the economy is booming up. Whereas structural is something which doesn't get affected much by the fluctuations in economy. For example, FMCG. So FMCG performance of FMCG does not vary as much as a cyclical industry. So here power generation, mining, oil and gas, they are linked with the economy. Secondly, for example, data center, consumer durable, renewable, railway components, they can be categorized under the category of structural industry. We can say that structural industry will have secular demand. Appliances and consumer durables 1.47%, data center 2.60%, railways around 32%, and renewable energy around 4.6%. So this all adds up to 40%. So almost 40% is secular demand or structural and user industries which are catered by Pitti, and the remaining 60% is cyclical demand. When we look at their client, we see some of them are really well-known names. For example, BHEL, L&T, Caterpillar, GE, ABB. This all reflects the fact that their client profile is really amazing and Pitti's products have a good image in the market. Now we will talk about industry tailwinds. Pitti can become the beneficiary of manufacturing capex cycle. Now what is capex cycle? India witnessed last capex cycle during 2003 to 2008 when a lot of capex was done by companies and real estate was also at a boom. Company took a lot of debt to expand their businesses. At that time, India's GDP was also growing at 8 to 10% for continuously 3 to 4 years, and it was a really good time for the Indian economy. After that, there was a slowdown in the economy and many companies started busting out. In every sector like steel, real estate, companies were defaulting and there was a slump in the economy. One of the reasons for that was 2008 economic crisis. In today's scenario, market has become consolidated. For example, in steel industry, only few major players are left. Similarly, in banking, companies which have survived have become more stronger in last 8 to 10 years. As per the general consensus and our understanding, we can say that India is at the cusp of new manufacturing capex cycle, similar to what had happened in 2003 to 2008. One major reason for that is China plus one. Due to COVID, China faced many problems in their supply chain, and many companies are trying to diversify their supply chain and reduce the dependency on China. So they are looking for the another alternative, and India fits in the right place. Many companies are shifting their manufacturing facilities to India. When you listen to the con calls of various pharma and chemical companies, you will come to know that China plus one is here. Now, second reason is that government has announced 7.5 lakh crore for capex outlay. This is a huge number as compared to last year. In last few years, many companies have been focused on paying back their loans. You must understand one thing here is that how capex cycle starts. Companies take debts from market and banks, and from that capex is done. This is generally how it happens. After 2008, company focus shifted towards deleveraging or repaying their debts, and the new capex which should have had happened didn't happen. Now, if there is no capacity addition, then supply in the market will take a hit. Now, to cater the increasing demand, more capex in the industries might be observed. Also, schemes like PLI scheme in textile, pharma and electronics may motivate companies to boost their manufacturing. Low cost of labor in India. China used to have a low cost, but as their standards of living are improving, labor costs have also become expensive. China's labor cost is 20 to 30% more expensive than what is of India's. Consolidation in various industries in last 8 to 10 years. As I've already told you about consolidation in various industries in last 8 to 10 years. I have already told you about this. Next is increasing capacity utilization. As I have told you that there wasn't much capacity expansion and the utilization of existing capacity is increasing. See, after a certain level, let's say 80 to 85%, you must bring in new capacity because you cannot keep on using the same old capacity if you want to increase your production. Next is lighter balance sheets of corporates across industries. As I have already told you, companies have become debt free. Now, if the companies have become debt free, they are ready to take loans for their capacity expansion. Low interest rate. This is also a major reason. Interest rates are now very low. Companies can raise money on a cheaper rate. Now, Economic Times did a survey on 56 CEOs and MDs, and out of those 56, 93% has said yes to the question, do you think a big investment cycle is about to start in India? Another question was, is your company lining up any capital expenditure during 2022 to 2025? So, 94% said yes to this question. What is your current capacity utilization? Almost 26 plus 42, 68% said that their capacity utilization is above 70%. And 42% said that their capacity utilization is over 80%. 45% think that a very sharp bounce back and high capacity utilization will be seen. 15% are still pessimistic. All these pointers and the survey are indicating that a capex cycle is about to start. World Bank has given a projection about India's manufacturing as percentage of GDP till 2030. It is estimated to reach 20%, which is currently at 13%. It used to be 17% in 2010, which has dropped to 13% till 2020, and absolute numbers have also not improved a lot. So, if manufacturing as percentage of GDP reached 20% and India's GDP is estimated to reach 5 trillion in 2030, then 20% of 5 trillion, that is 1 trillion, will be from manufacturing. So, it might become 3 times more in 2030 as compared to 2020. This is the scenario of whole industry, and imagine how much a good company can benefit from it. Many companies have already announced capex in the private sector. During April 20 to February 2022, a total of 12.4 trillion rupees capex was announced, which included all the industries during that period. And it nearly doubled from April 20 to July 2021 capex announcement, which was 6.6 trillion rupees. Major proportion of this capex is contributed by metal sector, and data center is also showing promising scope in this new capex cycle. In renewable, there was a huge capex announced by Adani, Ambani and Tatas. Already announced capex are giving clear indications that a new capex cycle is on the way. Reliance Industries is poised to ride India's growing shift towards green energy with a new 5.69 trillion rupee investment package focused on renewable sector in Gujarat. So Reliance Industries will be making 80 billion investment in the upcoming 10 to 15 years. In June, they had announced that they will invest 750 billion rupees for 3 years, which has been increased to 5.69 trillion rupees. A huge company like Reliance believes so much in the Indian economy that they are investing so much. It is a clear indication that a new capex cycle is almost about to begin. Various industry players are also giving the comments about the capex cycle. For example, Thermax, which is a leading energy and environmental solutions company. In Q3 of FY22 con call, they had said that to be bullish on the capex scenario, and the budget has definitely helped. Most of the executives I have spoken with are continuing to be bullish on capex scenario, and the budget has also finally helped. Kumar Mangalam Birla has also predicted decade of capex mahotsav, and this capex will be led by private sectors, not the government. So what I think is companies like Pitti can be a huge beneficiary of this capex
in the upcoming decade. Now, what are the major competitive advantages of Pitti? Pitti has developed deep customer relationship over the last many years and in many cases is a sole supplier to its customers. It takes at least 4 to 5 years to commercialize a product and hence it acts as an entry barrier in the industry. Basically, commercializing a product is a time consuming task. During Q2 FY22 conference call, management of PT was asked a question. What makes you better than your competitor? So to which they replied, most of our customers will take at least two years to get a vendor for registration done. And it will take almost 4 to 5 years for the vendor to get approved, then development of the product, then approval by the customer, and at last commercialization of the product. All this will take 4 to 5 years of their time. So for any new player, it is not easy to enter and gain customer in this industry. Now for example, ABB has supplier like Pitti for many years. Then why would they switch to any other supplier until and unless there is some major event? So sticky customer relationship is a huge advantage which Pitti has developed over the last 30 years. There are such few products which are only supplied by Pitti. In such scenario, many customers are solely dependent on Pitti as said by Akshay Pitti. As you can see here, they are solely dependent on us. Somebody asked Mr. Akshay Pitti that thus being sole supplier give them monopolistic position. On which he replied that yes, we are the sole supplier, but we would not call it a monopolistic position because we are in partnership with our customers and their journey of growth. So one advantage of being a sole supplier of some products is that it gives Pitti some pricing power. Next is integrated nature of operations. Pitti has wide variety of products. We have already been through this. They manufacture stator, rotor, laminations and many more products. Now listen to this very carefully. Suppose a customer wants laminations from Pitti, but the customer also wants some other parts of motors. And if Pitti is developing all those products, then why would a customer go to some other supplier? If a customer comes to Pitti for some products, and because of his integrated nature, it becomes very easy for Pitti to sell those products to his customers. Even Akshay Pitti has said that because of our integrated nature, we compete with 3 different industries. We have a fabrication facility, we have our own tool room, and we have our own machine shop. So, to replace us in the supply chain, first and foremost, my competitor needs to find 3 to 4 different companies, each in different field, and then find someone to integrate the product, assemble, and supply it as a ready-to-use unit. So it means that if a customer wants to replace Pitti, they have to find 3 to 4 different industries, and then it has to find another industry to integrate all those products. So it becomes a very time consuming and difficult task for customer. And because of all these reasons, their customers are very sticky. Next is moving up the value chain. Pitti has moved up the value chain from only loose laminations manufacturer to various value-added products. It enables Pitti to have higher margins, deeper customer relationship, higher customer wallet share, and higher customer stickiness. Akshay Pitti in one of the conference calls has also said that where we used to predominantly do lamination pattern and some bit of SMG, we started looking at moving up the value chain and try to command a bigger percentage of the spend that my customer does. This transition was majorly done in last 5 years and they have been successful in doing so. Akshay Pitti has also said that major chunk of our output comes from a fully assembled and ready to use product, so that it is the change that we have driven in the last 5 years which makes us indispensable as well as increases our margins. Now we will look at the major growth drivers for Pitti. Number one is they have announced a capex of 270 crore, which will boost their capacity from 40,000 ton to 72,000 ton by H1 FY24. So there is a significant 80% increase in the capacity going to happen in the upcoming 1.5 year. And their current capacity utilization has also reached to approximately 80%. From this, we can say that their products are in high demand. Second is robust order book of 978 crore as on 31st December 2021. In FY21, their revenue was 537 crore. So their order book is more than their last year's revenue. And 700 crore out of 978 crore is executable over next 9 months. A sure shot of 700 crore revenue can be expected in the next 9 months. Their working capital days is 92 and Pitti is focusing a lot on bringing this down to 75 days. If working capital will improve, then ROC will improve as well. Fourth is improving EBITDA per ton. As their value-added products will improve further, their EBITDA per ton should also improve. Fifth is railways and metros. Government is focusing a lot on railways and metros. A significant growth in this sector might happen. Since railways and metro is one of the biggest customer industry for Pitti, it can become tailwind for Pitti. Number 6 is really interesting. The plant which was set up by Pitti in Aurangabad, Maharashtra government will be providing Pitti some incentives for that. This incentive is approximately rupees 30 crore per year for the next 13 years. So this 30 crore will directly go in the bottom line of Pitti's financial statements. These incentives have not started yet, but when this will start, it will improve the profits of the company. So these were the key growth drivers of Pitti. Now we will look into the financials of the company. Pitti's revenue has grown from rupees 335 crore in FY15 to 682 crore in 9 months for FY22. Even if Pitti earns revenue of rupees 200 to 215 crore in the last quarter of FY22, the total might reach up to approximately 900 crore. So in the last 7 years, Pitti has almost grown 3 times. PAT has also improved from 9 crore in FY15 to 32 crore in first 9 months of FY22. If in the last quarter their profit is rupees 10 crore, their growth in PAT will be 5 times. A continuous improvement in the margins can be observed. Margins dropped to 6% in FY16. Since then, there is a significant improvement in the margins. FY21 was hit by COVID. Even then, they maintained their margin, which tells a lot about their pricing power. In FY22, their margins have dropped down to 14% because prices of commodities like steel have increased a lot. Even though prices of commodities have skyrocketed, Pitti has maintained its margin to around 14%, which shows that Pitti was able to pass on its prices to customers, which is really a good sign. ROCE, which was 2.92% in FY17, has increased to 20.16% in 9 months of FY22 annualized. When margins and working capital will improve further, ROCE will improve as well, and it can reach to 25%, which is very significant for a company like Pitti. Net block, which is gross block minus depreciation or total asset minus depreciation. They have been doing huge capex in the past few years. That's why you can see there is a significant rise in net block. And they are continuing to do capex. That's why it has risen from 285 crore in FY21 to 6 months of to 288 crore in 6 months of FY22. Now let's dive more deep into financial ratios. Here we have highlighted various ratios in green and red color. Green shows that ratios which are doing really good, and red shows that the financial ratios are not up to the mark. ROE is 15.36%, which is a really good number. Investors should keep a track of debt to equity ratio for Pitti because it is on a high side. Although their interest coverage ratio is decent, which is 3, but one must keep an eye on the debt to equity ratio. Promoter holding is also good, which is around 60%, but 20.5% is placed. Pledge is against the debt company has taken, but we cannot comment whether this pledge is good or bad because this pledge is done for loans and not for the personal use. This is also something investor must keep an eye on. In the coming years, this might decrease along with debt to equity. FII and DII holdings are on low side. FII and DII have shown in green because low FII and DII holdings gives us an opportunity to catch a company at cheap valuations. And when FII and DII enter, there can be a significant upmove in the stock prices. Working capital days is quite high, but according to the guidance of the management, this will go below 75 days. Interest coverage ratio is good, which is 3. Cash flow from operation is 275 for last 5 years. EBITDA is 339 crore for last 5 years. Now, CFO divided by EBITDA, which tells about how much company has converted to cash flow from EBITDA or how much is EBITDA to cash flow conversion. This ratio of Pitti is 0.81, which is a good number. Generally above 0.7 is a good number for this ratio. It shows that they are not just showing the profits but also converting those profits into cash. Free cash flow is minus 2 crore for the last 5 years. The reason for that is that most of the cash that they have generated from operations have been invested back in the capex. Dividend is 0%, which is good in this case because sometimes what happens is that when free cash flow of a company is low and debt is high and they distribute dividends, which indirectly implies that the company is taking loans from the banks and distributing dividends, which is not a good practice. But in this case, dividend is 0, which is good because their debt is on higher side and free cash flow is low as well. When this both parameters will improve, Pitti might be able to pay dividends. Now we will be projecting the future earnings till FY24. Their asset turnover is 2.5x. Asset turnover is how much revenue they are generating on the assets. For example, if they have assets of rupees 100 crore and those assets are generating rupees 250 crore revenue, that means asset turnover will be 250 by 100, 2.5x. Out of the 270 crore capex which Pitti is supposed to do, 100 crore is already done. So the remaining capex that has to be done is 170 crore. If you assume that asset turnover remains constant, then by FY24, 170 crore capex can generate 425 crore additional revenue. Last 9 month revenue was rupees 682 crore in FY22 and they have estimated around rupees 200 to 250 crore revenue for the last quarter. So the revenue for this year FY22 might go to rupees 940 crore. And even if we keep 940 constant till FY24 and add the additional revenue of 425 crore to that, then sales in FY24 might go up to 1365 crore. And on top of that, government is going to provide incentives of rupees 30 crore. So 165 plus 30 crore, the approximate and the estimated revenue till FY24 will become 1400 crore. EBITDA margins is 14% as of now, but we are estimating that prices of raw material will come down in the future, and also by looking at Pitti's past performance, EBITDA margins will move around 15%. So 15% of 1400 is rupees 210 crore. For depreciation, we have assumed it to be 50 crore, which includes current depreciation and the depreciation on upcoming assets as well. In last financial year, they had paid the interest of rupees 30 crore, and for that management has commented that the new capex will be funded mainly through internal accruals. Their debt might increase a bit more over the coming years, but significant repayment of debt is on the way. So we are assuming that interest to be 50 crore. So PBT is 110 crore, tax is 25%. So profit after tax is 83 crore. PAT for the last 12 months is 53 crore, and we are estimating that this PAT will rise to 83 crore in 2 years. So PAT can increase with 25% CAGR for next 2 years. Their current market cap is 1035 crore, and as per our estimates, PAT can grow at CAGR of 25% over next 2 years, and there can be PE re-rating as well, since stocks seem to be cheap as per PE and PS ratios. So there can be two scenarios in this. If PE remains constant for next 2 years, even then, looking at the earning growth, which is 25% CAGR, we can expect a rise in stock price. Or second scenario is if there is a PE re-rating, or if there is a rise in PE in the coming time, a significant uptick in the stock price might be observed. Key business risks. Number one is delay in capex cycle pickup. So if COVID hits again, or if there is any other issue, then it will affect Pitti a lot, because 60% of the business is capex driven and user industry. Second is raw material supply disruptions and increased prices. So if raw material prices remain high for a long time, it will affect the profit of the company. Third is pledged promoter shares. So it is also something that must be tracked by the investors. Fourth is high debt. Fifth is overpromise and underdeliver. So Pitti is targeting 1000 crore revenue for last 4 to 5 years. In 2014, they had said that they will reach the target of 1000 crore revenue by 2016. But it is 2022 now, and they haven't reached that target yet. And they have also said that till 2024 this revenue will reach to 1800 crore. Since they have overpromised and underdelivered last time also, so as per our calculations we have estimated it to be 1400 crore instead of 1800 crore. Number 6 is execution risk. Execution is the risk if there is some disruptions in the capex. Now let's see where does Pitti fit in Tailwinds framework. So it falls under the category of fast growers and cyclical industry, because 60% of its revenue is coming from cyclical industries, and it is fast grower also because they are expected to grow at 25% CAGR, which we had seen earlier. If you want to know more about this Tailwinds framework, I have told this about in my previous video. Please go and watch that. We are not SEBI registered advisor. This video is only for educational purposes, and please take your financial advisor's advice before making any investment decision.